Hey everyone, and welcome to another deep dive. Today we're tackling a really interesting approach to personal finance and investing.
Yeah.
It's J.L. Collins and his book, The Simple Path to Wealth.
Right.
I know you've mentioned to me you're really interested in financial independence and,
Absolutely.
kind of getting on that path. And I think this book is a great place to start.
Yeah, it's definitely a good one. And I like how J.L. Collins explains things.
Yeah.
He doesn't get too bogged down in the jargon.
No.
Very easy to understand and follow.
Well, and I think what's really appealing about it is that he wasn't always this, finance guru.
Right.
He was like a regular guy.
Yeah.
Who wanted to figure out this whole money thing.
Exactly.
And I think that's what makes him so relatable,
Yeah.
especially for somebody who, maybe hasn't spent their whole life, reading finance books and all that.
Yeah, for sure.
One of the things that really stood out to me when I first read this book was this whole concept of FU money.
Oh, yeah, the FU money.
Have you heard of this concept before?
Yeah.
Like, what's your take on it?
Well, he's basically saying, you want to have enough money that you can walk away from anything, really.
Yeah.
Like a bad job.
A bad relationship.
Yeah, a bad relationship. Just about anything that you don't want to be in.
And I think what's so cool about it is he tells this great story about how his boss asked him to do something unethical.
Right.
And because he had that FU money, he was like, nope, I'm out of here.
Absolutely.
I mean, how empowering is that?
It is very empowering.
To be able to just walk away from a situation that you're not comfortable with.
Yeah, it's like having that freedom, that
Yeah.
choice to just say no.
Right. And I think that really ties back to this idea of financial independence, which you mentioned is something you're working towards.
Yeah, definitely.
So, okay, so we love the idea of FU money, right?
Mm.
But how do we actually get there? What's his formula for building wealth?
Well, it's actually pretty straightforward,
Mhm.
and it's almost deceptively simple.
Okay.
You spend less than you earn, you invest the surplus, and you avoid debt.
Yeah, and he really hammers that home like throughout the whole book.
Absolutely.
Avoid debt, avoid debt, avoid debt.
Yeah, he's like the anti-debt crusader.
And it makes sense though, right?
Yeah.
Because debt really can hold you back.
Oh, absolutely.
But I think what's interesting is that while this formula sounds simple,
Yeah.
it really requires a shift in mindset, doesn't it?
Yeah.
It's not just about, knowing the numbers.
It's about changing your habits.
It's about changing your behavior.
Yeah, your behaviors, yeah.
Yeah.
Your relationship with money.
Exactly.
Exactly.
And I think that's one of the things that he does so well
Yeah.
is he really challenges that consumerist mentality.
Yeah.
Like that constant urge to buy the newest gadget,
Yes.
to upgrade to a fancier car.
Yeah.
Yeah,
Yeah, keep up with the Joneses, basically.
Yeah, exactly. And to really drive this point home, he introduces this concept of opportunity cost.
Right.
Have you heard of this?
Yeah.
Like it's this idea that every time you spend money on something,
Yeah.
you're giving up the opportunity to invest that money and let it grow over time. He gives a great example in the book
Yeah.
about buying a car.
Right.
And he talks about a $20,000 car
Yeah.
and how over 10 years,
Yeah.
if you factor in the potential investment returns,
Right.
that car could actually cost you closer to $40,000.
Yeah, because you're missing out on that growth.
Yeah.
That compound growth.
So it's really about looking at spending through that lens of what else could this money be doing for me
Absolutely.
if I wasn't spending it on this thing?
Yeah. And that's a powerful way to reframe your thinking
It is. It is.
about spending.
Yeah. So, okay, we're spending less, we're saving more,
Mm-hmm.
and now it's time to invest that hard-earned money, right?
Right.
But he's a big believer in the stock market.
He is.
Like, even with all its ups and downs,
Yeah.
like, why is he so bullish on stocks?
Well, he does acknowledge that the market is volatile.
Yeah.
But he firmly believes that over the long term,
Yeah.
the stock market trends upwards.
Yeah.
And he points out that despite all the crashes and corrections,
Mm-hmm.
the market has consistently gone up over time.
He gives a great example with the Dow Jones.
Yeah.
Talking about how it went from like 616 in 1974 to over 17,000 in 2014.
Right. That's a huge jump.
Yeah.
Massive growth.
So it's really about taking that long-term perspective.
Yeah, and not getting freaked out by
Right.
the short-term fluctuations.
But, I think a lot of people, myself included, get scared by those big, ugly events that he talks about, like the 1929 crash or the 2008 financial crisis.
Right.
Those things are scary.
Yeah, and he doesn't sugarcoat it either.
Yeah.
He's very upfront about those.
Yeah, he has a whole section on those big, ugly events.
He does.
But what's interesting is that he doesn't see them as reasons to avoid the market altogether.
Right?
He actually says that understanding them
Yeah,
can help us navigate them more effectively.
absolutely.
So how does he suggest we handle these inevitable market downturns?
Well, he had some great stories about his own experience riding out the 1987 crash.
Right.
And he basically says that it's all about sticking to your plan,
Okay.
not panicking.
Not selling when everybody else is selling.
Exactly.
Yeah. And this is where his whole perspective on the psychology of investing comes in.
Right.
He talks about how fear and greed
Yeah.
drive most investors to make bad decisions.
Yeah, they get emotional.
Right? They buy high, they sell low.
Yeah.
And he's basically saying you got to overcome those emotional impulses.
Yeah.
And focus on the fundamentals.
Exact.
So, okay, we're ready to invest. We're thinking long term. We're keeping our emotions in check.
Yeah.
But where do we actually put our money?
That's the big question, right?
Yeah, he seems to have a strong preference for a particular type of investment.
He does. He's a big advocate for index funds.
Okay.
He's not about picking individual stocks.
So he's not a stock picker.
No.
Yeah.
He thinks that that's a recipe for disaster.
For most people.
For most people, yeah.
Okay.
He actually has this funny analogy about martial arts.
Oh, yeah. I love that story.
He says that his martial arts instructor always told him
Yeah.
that the simplest, most direct techniques
Right.
are often the most effective in a street fight.
So basically saying, like, don't try to get too fancy.
Yeah.
Just stick with the basics.
Exactly.
Okay.
Make it simple.
So with investing, he's saying, like, don't try to outsmart the market
Yeah.
with all these complicated strategies.
Right.
Just stick with the simple index funds.
Just buy the whole market.
Yeah.
Why try to beat it?
Okay, and specifically, he recommends Vanguard's Total Stock Market Index Fund,
Yeah.
VTSAX,
VTSAX. Yep.
which is basically a low-cost way to invest in the entire stock market.
Yep.
So you're not trying to pick winners and losers.
No, you're just going along for the ride.
Okay, so index funds are like the foundation of his investment strategy.
Absolutely.
But what about bonds?
Right.
Doesn't he talk about those too?
He does, but his primary focus is on stocks for long-term growth.
Okay.
He sees bonds playing a more specific role in a portfolio. He views them as a way to smooth out market volatility,
Okay.
especially as you get closer to retirement.
Right.
He even compares bonds to shock absorbers on a car, helping to cushion the bumps along the road.
So it's not that he's against bonds entirely,
No.
but he sees them playing a more strategic role.
Right.
Especially for those who need to balance risk and stability as they approach retirement.
Exactly. And this ties into the concept of asset allocation, which is essentially deciding how much of your portfolio you dedicate to stocks versus bonds.
Got it.
Collins outlines two main approaches:
Okay.
the wealth accumulation portfolio
Okay.
and the wealth preservation portfolio.
Okay, break those down for me. What's the difference?
So the wealth accumulation portfolio is designed for those who are in the early stages of their financial journey.
Okay.
Like, you know, that 26-year-old we were talking about. Collins recommends going all in on stocks.
Yo, 100% stocks.
Yeah, 100% stocks.
That seems pretty aggressive.
It is.
Okay.
But remember, Collins is all about taking advantage of the long time horizon these younger investors have.
Okay.
He argues that over the long run, stocks have the highest potential for growth, even with their volatility.
Okay.
So he's basically saying, ride those waves, stay the course, and you'll come out ahead.
But as you get closer to retirement, you'd want to shift to a more conservative approach, right?
Right.
That's where the wealth preservation portfolio comes in.
Exactly.
Yeah.
So the wealth preservation portfolio includes bonds
Okay.
to provide that stability
Right.
and reduce volatility.
Got it.
The exact ratio of stocks to bonds depends on your individual risk tolerance and circumstances.
Okay.
But the key is to adjust your allocation as you move through different life stages.
So it's not a set it and forget it approach.
Yeah.
You need to be actively managing your portfolio
Yeah, you got to stay engaged.
as your circumstances change.
Exactly.
Now, one thing that really stands out about Collins is his unwavering support for Vanguard.
Yeah, he's a big fan.
He almost sounds like a spokesperson for them at times.
Yeah, he really likes Vanguard.
What's the deal with his Vanguard obsession?
Well, it's not just blind loyalty.
Okay.
He has some pretty solid reasons for preferring Vanguard.
Yeah.
He's a big fan of their unique ownership structure.
Okay.
Vanguard is actually owned by the investors in its funds.
So it's like a co-op?
Kind of like a co-op, yeah.
Where the customers are also the owners.
Exactly.
That's pretty cool.
Yeah, it's a pretty unique model.
Okay, so that means their interests are aligned.
Right.
Vanguard doesn't have to answer to shareholders who are pushing for higher profits.
Exactly.
Okay.
Their focus is on providing the best possible service and the lowest possible fees for their investors.
That makes a lot of sense.
Yeah.
And that aligns perfectly with Colin's philosophy.
Absolutely.
Of keeping costs low and simplifying the investing process.
It's all about keeping it simple and affordable for
fun.
the average investor.
Now, he also spends a good chunk of his book talking about the importance of tax advantage accounts.
He does.
Things like 401ks and IRAs.
Yep, those are the big ones.
Why are these so important?
Well, he sees these accounts as essential tools for building wealth,
Okay.
especially for retirement.
Mm.
He emphasizes maximizing your contributions to these accounts,
Right.
taking advantage of those tax benefits,
Right.
and letting your money grow tax-deferred.
So you're basically sheltering your money from taxes.
Yeah, you're giving it a nice little tax break.
While it's growing.
Exactly.
But he also warns about a potential tax trap that people often overlook.
Oh, yeah.
Something about required minimum distributions, or RMDs.
RMDs, yeah, those can be a pain.
Okay, so what are RMDs and why are they a problem?
Essentially, once you reach a certain age, usually 72,
Okay.
you're required to start withdrawing a minimum amount from your tax-advantaged retirement accounts each year.
And those withdrawals are taxed as ordinary income.
That's right.
So even though you've enjoyed tax-deferred growth for years,
Yeah.
you'll eventually have to pay taxes on those distributions.
Eventually, Uncle Sam gets his cut.
Yeah, and depending on your income level and tax bracket,
Yeah.
that can be a significant chunk of change.
It can be a big hit.
So Collins points this out, not to scare people,
Right.
but to encourage them to be strategic.
Absolutely.
Okay. So what does he suggest we do to mitigate this potential tax hit from RMDs?
He offers a few strategies like Roth IRA conversions
Okay.
and carefully planning your withdrawals.
Got it.
But the key takeaway is to be aware of this issue
Right.
and factor it into your overall retirement planning.
Don't just assume that all your retirement income will be tax-free.
Exactly. You got to be proactive.
Okay, he also mentions HSAs, health savings accounts.
Oh, yeah, HSAs.
I have to admit, I haven't really looked into those much.
They're a hidden gem.
Okay.
A lot of people don't know about them.
Tell me more about them. Why are they so great?
Well, Collins sees them as a powerful tool for managing healthcare costs,
Okay.
especially for those with high deductible health plans.
Got it.
He points out that contributions to HSAs are tax deductible.
Yeah.
The money grows tax-free, and you can withdraw it tax-free for qualified medical expenses.
Wow, so it's like a triple tax advantage.
Triple tax advantage, that's right.
That's amazing.
It's a pretty sweet deal.
So not only can you use HSAs to cover healthcare costs,
Yeah.
but you can also let the money grow for the future.
Exactly.
That's a great tip.
Yeah, it's a nice little bonus.
Now, one thing that surprised me about Collins is his skepticism towards financial advisors.
Yeah, he's not a big fan of financial advisors.
Why is that? Don't most people benefit from having an expert to guide them through these complex financial decisions?
Well, that's the conventional wisdom.
Right.
But Collins argues that financial advisors often have conflicts of interest.
Okay.
They might be incentivized to sell you products that earn them commissions, even if those products aren't in your best interest.
So he's saying you need to be cautious
Absolutely.
and do your own research.
Yeah, do your homework.
Before entrusting your hard-earned money to someone else.
Exactly. Don't just blindly trust anyone
Okay.
when it comes to your money.
Now, another common investment strategy that Collins seems to have a different perspective on is dollar cost averaging, or DCA.
Oh, yeah, DCA.
What's his take on that?
It's a popular strategy,
Right.
especially for those who are nervous about investing a lump sum all at once.
Yeah, I get that. It feels safer, like you're mitigating risk
That's the appeal.
by spreading out your investments over time,
Right.
buying a fixed amount at regular intervals.
Exactly.
But Collins argues that DCA can actually lead to underperformance.
Yeah, he thinks it can be a drag on your returns,
Okay.
especially if the market is trending upwards.
So he's saying it's better to rip the Band-Aid off and invest the lump sum when you have it.
Yeah, he's a fan of lump sum investing.
Okay, but that takes a certain level of confidence. I think a lot of people would hesitate to put all their money in at once.
Yeah, it can be scary.
Okay.
But he emphasizes that this is where understanding market trends and having a long-term perspective are crucial.
So it's about having conviction in your investment strategy.
Right.
And not letting fear dictate your decisions.
Exactly.
Now, he also talks about financial predators.
He does.
And the importance of protecting yourself from scams.
Yeah, those are out there.
Right.
You got to be careful.
He shares a hilarious anecdote about the free lunch mentality.
Oh, yeah, I love that story.
And how it can attract financial predators.
Yeah, people are always looking for something for nothing.
Right.
And that's where the scammers come in.
So it's about being cautious and not falling for those too good to be true offers.
Exactly. If it sounds too good to be true.
Yeah, it probably is.
Now, we can't forget about the infamous 4% rule.
The 4% rule.
Which has become a sort of golden rule for retirement planning.
Yeah, it's a classic.
What's his take on that? So the 4% rule suggests that you can safely withdraw 4% of your retirement portfolio each year.
Okay.
Without running out of money.
Okay.
It's based on the Trinity study,
right,
which analyzed historical market data to determine a sustainable withdrawal rate.
Got it.
But Collins doesn't seem to be a big fan of rigidly following the 4% rule.
Okay, so why not? What's wrong with it?
Well, he acknowledges its usefulness as a guideline.
Okay.
But he emphasizes that it's not a magic formula.
So it's not a guarantee?
No, there are no guarantees in the stock market.
Okay.
He advocates for a more dynamic approach.
Sure.
Adjusting withdrawals based on market conditions and personal circumstances.
So it's about being flexible and adaptable.
Yeah, you got to be able to adjust.
Not blindly adhering to a fixed percentage.
Exactly.
Okay. And speaking of retirement planning, we can't forget about Social Security.
Right. Social Security.
It's a big part of the puzzle for a lot of people.
It is.
What's Collins' perspective on Social Security?
He views it as a valuable safety net. But he cautions against relying on it as your primary source of retirement income.
He's essentially saying, don't put all your eggs in the Social Security basket.
Exactly. You don't want to be solely dependent on Social Security.
Okay.
He encourages listeners to plan for financial independence as if Social Security won't be there, using it as a potential bonus,
right,
rather than a core element of their strategy.
So it's about taking personal responsibility for your financial future.
Yeah.
And not assuming the government will take care of everything.
Right.
Now, this brings us to a really important point that Collins emphasizes throughout his book.
Yeah.
Living a rich life is about more than just accumulating wealth.
Absolutely.
It's not just about the numbers.
No, it's about what those numbers enable you to do.
Right.
It's about using money as a tool to create a life that aligns with your values and passions.
I love that about his philosophy.
Me too.
It's not just about being rich.
Right.
It's about living a fulfilling life.
Exactly.
And I think he demonstrates that really well in the book.
Yeah.
He talks about his own life, his travels, his family, his charitable giving.
Yeah, he walks the walk.
He really does.
He's not just talking about it.
Yeah, so it's about aligning your financial goals with your life goals.
Absolutely.
Now, before we wrap up,
yeah,
I think it would be helpful to recap the core principles of J.L. Collins' Simple Path to Wealth.
I agree. It's a lot to take in.
Yeah, and having a concise summary can be really valuable.
For sure.
Okay, so let's distill it down to 10 key takeaways.
Right.
Think of this as your cheat sheet for financial success.
I like it.
Inspired by J.L. Collins.
Sounds good. Let's do it.
All right, point number 1, FU money is your foundation for freedom.
Yeah, it's that financial cushion that gives you choices, you know? Lets you make decisions based on your values and not just out of necessity.
All right, okay, point number 2, spend less than you earn, invest the surplus, and avoid debt at all costs. That simple formula applied consistently can really build wealth.
Yeah, it's like, you know, laying those bricks one by one, building that financial fortress.
Yeah, I love that analogy.
Mm.
All right, number 3, understand the concept of opportunity cost.
Uh-huh.
Every spending decision has a trade-off. Consider what that money could be earning if it were invested wisely.
Right. It really helps you see those unseen costs.
Yeah.
And make choices that align with your long-term goals.
Okay. Moving on to number 4. The stock market relentlessly rises over time. There will be volatility and crashes, but the general trend is upward.
Yeah, you can think of it like a roller coaster. You know,
Right.
that eventually climbs higher.
Yeah. Number 5, index funds like VTSAX are your simple and effective path to capturing market returns.
Yeah, it's like a diversified low-cost vehicle that just takes you along for the ride.
Number 6, bonds, specifically VBTLX, can smooth out the journey and hedge against deflation.
Yeah, they're like the shock absorbers on your financial vehicle.
Right.
Making the ride a little bit less bumpy.
Number 7, determine your asset allocation, that mix of stocks and bonds based on your own risk tolerance and life stage.
Right. It's about customizing your own financial strategy to fit your own individual journey.
Okay, number 8, Vanguard. With its investor-owned structure, it's a trustworthy and investor-friendly company.
Absolutely. They've got your back.
Right.
You know, they're looking out for your best interests.
Number 9, take advantage of tax-advantaged accounts like 401ks and IRAs.
Yeah, you got to use those tax breaks to your advantage.
And last but not least, number 10, watch out for those financial predators and protect yourself from scams.
Yeah, if something sounds too good to be true,
Right.
it probably is.
So there you have it, the 10 commandments of J.L. Collins' Simple Path to Wealth.
There you go.
We've given you a solid look at his core principles.
Yeah.
I really encourage you to explore his work further.
Absolutely.
His book is a great read for anyone who wants to achieve financial independence.
It's very approachable.
Yeah.
Very easy to understand.
Yeah, and I think his philosophy is really all about taking control of your finances.
Yeah.
And using your money to create the life that you want.
Right.
He emphasizes that the most valuable thing that money can buy is freedom.
Yeah, freedom and choice.
So think about what freedom looks like for you and how you can use these principles to achieve it. Until next time, keep diving deep.
Happy investing.